Do you guys want to turn £100 into a £100,000 investment portfolio without actually having to find the next Apple or Amazon, and by doing minimal amounts of work along the way? Well, in today's video, I'm going to share with you guys a strategy that actually beats 90% of stock market investors and will provide you returns that will allow you to achieve this size of a portfolio, not overnight, but over time. But before I do so, guys, my name is Mitch. I post all kinds of videos on investing in the stock market. If you do enjoy content like that, hit that big red subscribe button down below as well. Drop a like on the video, guys. It really does help out the channel. With that being said, let's dive straight into it. Now, I appreciate investing in the stock market can be bloody overwhelming, especially if you're an investing beginner. You hear all of these different terms like dividends, growth stocks, ETFs, index funds, financial reports, and all of these financial terms that perhaps you haven't come across before. Plus, to compound this problem, if you're anything like me, you didn't actually get taught what an ETF was at school, or even indeed how to grow an investment portfolio. So today I'm going to do my very best to provide the financial education that I know we all missed out on, and actually provide you guys a very simple strategy that you can follow. Now, I really do want to emphasize the word simplicity here, because there are a huge number of people, over 90% in fact, who actually massively overcomplicate the art of investing. There are so many investors out there that are looking to gain a quick buck from investing in the stock market. There's so many people that are looking to find the next Tesla, the next Amazon, the next Apple, and by doing so, they're looking for hundreds, if not thousands of percents worth of returns on their investment portfolio in such a short period of time, which simply isn't feasible. But the reality is there is approximately 630,000 publicly traded companies all around the world right now, which means unless you've actually got a hell of a lot of time, effort, energy, and expertise, it's going to take you such a long time to actually sift through all of these companies and find the very finite few that are going to actually beat the overall stock market average over the course of the long term. And in my humble opinion, I believe it's probably best to leave this down to the professionals down on Wall Street and down on Canary Wharf too. And as John Bogle, founder of Vanguard, which is the largest mutual fund company in the world, once said, instead of actually trying to find the needle in a haystack, instead just buy the whole haystack. And that's the strategy that I want to talk to you guys about today, which is ETF investing. So what exactly are ETFs? Well, ETF stands for Exchange Traded Fund. And essentially these funds are put together to track different stock market indices as well as different industries too. Well, think about it like this. Let's say that you did start to invest in Apple stock because you believed it had a great amount of long-term potential. However, let's say in a hypothetical world, Apple released the iPhone 12 and sales absolutely flopped. People just realized that the iPhone was pretty much the same as it has been over the course of the past 5 years, and because of that, demand fell through the floor, and as a result of that, quarterly earnings were terrible, and as a result of that, Apple's share price fell through the floor. Well, not only would Apple lose a hell of a lot of money in this circumstance, but also driven by their failures, your investment portfolio would also be failing too. And that's the risk of having all your eggs in one basket in the form of Apple and looking to actually pick individual stocks from the stock market. If the company in which you've singularly picked out, which you believe has great long-term potential, doesn't live up to that potential, or indeed has a string of failures along the way, then not only will that company fail, but also your investment portfolio will also take a tumble too. However, let's say the same thing happened to Apple in this scenario, but instead of just investing into Apple, you had exposure to Apple, but instead through a VUSA S&P 500 ETF. But what actually is the VUSA S&P 500 ETF? Well, it's actually a fund on Vanguard which tracks the overall S&P 500 index as a whole. So what that means for you as an investor is not only will you gain exposure to the likes of Apple, but you'll also have exposure to the likes of Amazon, Microsoft, Facebook, Disney, and about 500 other companies too. Which means if Apple messes up, or even another one of these companies has a string of failures along the way, which results in their stock price declining, you won't be so exposed to that individual stock because you'll be invested in about 505 different companies on the whole. And what makes the S&P 500 index so appealing to so many investors out there, if there are companies that are going on a string of failures and they're actually not making up the criteria for the S&P 500, that list actually gets reviewed and refreshed every single quarter. So the failing companies drop out the S&P 500 and the up and coming companies go back into the S&P 500. So because of that, you're only ever gaining exposure to the top 500 companies in the United States of America at any single point in time. So because of that, you minimize your risk as an investor to single company risk as well as sector risk, because on the whole, you're invested in a hell of a lot of companies across a lot of different sectors. Now, to give you guys some of the numbers, over the course of the past 100 years, the S&P 500 has returned about 9.8% per year. Now, what that doesn't mean is that you're going to incrementally gain 9.8% per year on the value of your portfolio. Instead, what it does mean is that the portfolio itself perhaps will be up 20% in one year, but then it might be just 5% the following year. Or even if we see recessions like we've seen when we saw the dot-com bubble bursting, as well as when we saw the financial crisis in 2007, the portfolio itself could take a bit of a tumble too. But nonetheless, over the course of the long term, the S&P 500 has certainly come out on top. So to give you guys additional context on how this would all work in terms of turning £100 into a £100,000 investment portfolio, well, if you invested £100 per month, which is £1,200 per year, if you did this for 6 years, you'd achieve a £10,000 investment portfolio. But the longer you can leave your investments and the longer that you can continue to invest into the market will benefit you massively through the power of compound interest, because not only will your investments increase on a linear scale, but it will actually be exponential growth that you receive over the course of the long term. And to put this into perspective for you guys, if you did this same scenario, £100 a month, £1,200 a year, for 15 years, your investment portfolio would be worth £41,000. If you did this for 30 years, it'd be worth £210,000. And if you did this for 40 whole years, your investment portfolio would be worth £556,000. Now, at this point, you may be saying to me, well, Mitch, actually £556,000 40 years from now will not be worth the equivalent of £556,000 today due to inflation. To which I would say certainly you are right in thinking that, because currency does devalue over the course of time, which makes it so important to actually invest into asset classes that can certainly outpace the levels of inflation, which over here in the UK, the Bank of England have a target inflation rate of about 2% per year. So here are an additional 3 ways that you can actually maximize the power of compounding and actually grow your portfolio and grow your overall wealth in the best possible way. The first is consistency. It's not always about being able to dump a big lump sum investment into the stock market today. It's actually about investing, small regular chunks of money over the course of the long term, because that can certainly warrant just as good a return. The second is scale. The more money that you can naturally invest into the stock market, you may wish to start off with £100 a month, but then that may grow to 200 to 500 to 1,000 to 2,000. The more in which you can invest into the stock market, the more your money will actually grow over time. And third and finally, the obvious, is actually how much time can you spend in the market. The longer in which you can allow your money to work for you in the stock market, the more in which you will benefit. It's not about kind of buying and then selling and being quite reactive and active in the stock market on the whole. It's just simply taking a step back, becoming more of that passive investor, just investing into the stock market and letting it grow over a 20, 30 or 40 year period. But what if you actually don't want to get all tied up in the US stock market, and for you personally, that's not the way in which you want to go with your portfolio? Because perhaps you see great potential growth opportunities in different sectors or even perhaps different countries on the whole. Perhaps you'd like to look into the electric vehicle market, which is certainly a growing industry on the whole, as well as perhaps the renewable energy market as well. 2 markets which are actually very much on the global agenda right now. Well, for those of you guys who do have that appetite to invest in perhaps renewable or clean energy stocks, well, you can look towards ETFs like the iShares Global Clean Energy ETF, which has returned an average annual rate of return of about 18% over the course of the past 5 years. Or in the electric vehicle space, on the other hand, you can invest in an iShares Electric Vehicle and Driving Technology ETF, which has holdings like Tesla, General Motors, Xilinx, Nvidia, and many more. Now, you can access all of these funds and a hell of a lot more on an app called Trading 2 on 2, which is the app in which I personally use to invest into ETFs as well as individual stocks too. And if you guys want to, feel free to use the link down in the description below to sign up to Trading 2 on 2 to get 1 free share valued up to £100. So in a nutshell, guys, don't try and beat the market. Don't try and look for the needle in a haystack, because 90% of stock market investors simply fail to beat the overall stock market average. Instead, just simply buy into a low-cost ETF which tracks the overall market, or at least tracks an industry or a sector in which you're personally interested in for long-term potential growth. Because essentially what that allows you to be is more of a passive investor. It means that you're not having to stay up to date with financial reports. It means that you're not having to manage your overall portfolio on the whole, and instead you're leaving that up to the professionals who manage the fund to do it for you. And then all you need to do is to continue to invest into the stock market, have confidence in your strategy, and then simply wait 10, 20 or 30 years to allow the power of compounding to really take effect on your investment portfolio and on your overall wealth on the whole. And with that being said, guys, I really do hope you did enjoy this video. Hopefully it was very valuable to you guys. If you did enjoy it, be sure to smash a like on it. It really, really does help out the channel. As well, subscribe if you are new around here. And with that being said, I will see you over in the next video.